Travillian Next is a division of Travillian, a financial services specialist search and talent advisory firm. Since inception, the Travillian team has dedicated itself to enhancing the return on investment of a company's most important resource, its people.
Hello, everyone. I'm Brian Love, head of Banking and Fintech at Travillian. I am joined today with Matt Resch. Matt, good friend of the firm for many years. Would you like to introduce yourself?
Sure. Good morning, Brian. Good morning, everyone. Brian, really appreciate the opportunity to participate with you today. So just a brief background on myself. I co-founded Ambassador Financial Group in September of 2006. It was an advisory, consulting, and investment banking firm, primarily covering the depository space. And we grew that platform through 2019, at which point PNC acquired our firm, and I co-led the PNC FIG advisory effort for 4+ years. Most recently, I decided to take a little time off, what I categorize as a career sabbatical, but continue to be plugged into the industry and thinking about the next endeavor for myself. So again, really appreciate the opportunity, Brian, to chat with you about some of the opportunities and challenges the banking industry faces.
Yeah, and Matt, you're right here in our backyard in the southeastern Pennsylvania. I know you're in the Lehigh Valley, but we're going to talk about banking on the whole across the industry, the hot topics that banks from California over to the Atlantic are thinking about right now. The first hot topic I thought to bring up to you would be M&A. There's been some, deals trickling in. Obviously, M&A is way down as, compared to other years prior. I wanted to get your thoughts about, what to potentially anticipate in the M&A space. I know also there's been some MOEs out there that might be interesting for us to talk about as well, and including one or two reverse MOEs, if you want to call them that. So Matt, what's your take? Will these trends continue? Will things change? Love to hear your thoughts.
Yeah, thank you, Brian. Well, M&A, it doesn't matter what the environment is. It's always a hot topic, and our industry has consolidated, for decades. I mean, if we think about it, back in the 80s, we had 18,000 plus charters. Today, we're currently sitting at a little over 4,700 charters. So the industry has consolidated and will continue to consolidate. I think some common themes that are facing the industry today on the M&A front is that deal math remains extremely difficult. I'm stating the obvious, but acquirers have little to no currency strength. Since the Fed began raising rates really in March of 2022, to put some context around that, the NASDAQ Bank Index and the S&P Regional Bank Index are down, both over 40% again since the commencement of the rate rising campaign by the Fed. And it's well documented, how the rise in interest rates has complicated the balance sheet marks and the impact to tangible book value dilution. And so, while everyone is hopeful the Fed is going to pivot and lower rates, we all know that hope's not a strategy. And unless and until something breaks, the Fed probably isn't done raising rates. If we listen to them and what they're saying, and it's clear they would like to keep rates higher for longer. So in other words, the days of zero interest rate policy or ZIRP are a distant memory. So, having said all of that, it's clear that the industry will continue to consolidate. I've been doing this for a very long time. I can tell you that the percentage of bank management teams and the boards of directors of banks of all sizes who are willing to find a partner is as high as I've ever seen in my career. I think that the catalyst for that clearly is the fact that they're just not having any fun right now, given all the challenges and headwinds our industry faces. So, challenges on the funding and liquidity side, net interest margin contraction outside of the really large banks, a higher cost of capital, increasing credit cycle concerns, and then certainly heightened regulatory scrutiny, or a term I've coined, which is the regulatory misery index that bank management teams and boards of directors are facing. So they're just not having a lot of fun, and consequently, they're certainly willing to find a partner, even though the deal math is challenged. So as we move forward, as the deal math becomes more palatable, I do believe we could see the industry shrink by 30 to 40% over the next 5 years as far as numbers of charters as the sellers rush to the exit. I think we've talked about scale for decades, but in this market, scale clearly matters, as evidenced by the performance bifurcation that I think we've seen and will continue to see between the really large banks and everyone else. We're certainly in the midst of third quarter earnings season, and so large bank earnings are out. They've announced solid earnings, and some of them are actually experiencing growth in net interest income because they enjoy a much better funding structure, more transactional accounts. But additionally, they're not as reliant on the net interest margin given the diversification of their revenue streams and sources of non-interest income. So as we move kind of through earnings season, I think we're going to see a very significant bifurcation in the juxtaposition between larger bank earnings and smaller bank earnings. Smaller banks simply don't enjoy the same earnings profile. They're much more reliant on the on the NIM because they don't have as many sources of revenue diversification and non-interest income. So thinking about the next couple of quarters and the comparisons to prior year quarters, I think we might see the biggest decline in net interest margin that we've seen in our industry, at least in my career, if not since the 1980s. And so, the reality is we're, pushing 18 months into the rate rising campaign. And so banks are aggressively, paying up for deposits. The competition for funding is fierce and very expensive. Excuse me, it certainly feels like an arms race. And so that's just catching up, and their assets aren't repricing as quickly. They have a lot of legacy assets on their balance sheets that are low yielding and underwater, and so that's going to harm or dampen most bank earnings. So to that end, I believe that consolidation in M&A is a solution. There are lots of conversations going on. I would recommend that all banks should be talking to partners up and downstream always. But if they can get creative on deal math, we think about the PacWest Bank of California, because you had mentioned reverse merger. That's a blueprint, I believe, that I think others are going to follow, where you have a legal acquirer that has a stronger currency, but you have an accounting acquirer, which in this case, PacWest will be the accounting acquirer to mark the smaller bank, which is Bank of California, which can make the deal math work. So there's a lot of smart folks out there in the investment banking community who can come up with some of these creative deal structures. You also talked about MOEs. I think we will continue to see more MOEs. MOEs really proliferated back in 2019. MOEs were always happening in our industry, but they typically happen with really small institutions getting together. We started to see the advent or the proliferation of larger bank MOEs in 2019. I think the MOE trend will continue. I think we need scale, and I know that there are many of those discussions occurring as well.
You also mentioned earnings. As this is being recorded, we're like right in the middle of Q3 earnings. I know you had mentioned, and we've seen larger banks have reported very solid earnings. Any other early news out there, and any prognostications that you have, Matt, about earnings season?
Yeah, Brian, again, the early read, not surprising. The big banks are adept at announcing strong earnings, so I'm not surprised by that. And in some of those cases, they've seen expansion in their net interest income at a time where, as I mentioned earlier, NIMs are going to contract by and large for the entire industry, but they have enjoyed much different, funding structures. But the other issue that's facing the industry, there has been an uptick in credit losses, not surprisingly. Prior to the environment that we find ourselves in, we've probably been in the most benign credit environment for the industry. I think that this quarter, at the community bank level, by and large, you'll still see some pretty benign credit, but inevitably that's got to catch up, right? Lending is contracting. The consumer, despite the strong retail sales number this morning, I think is getting more and more levered. And so nothing goes in a straight line forever. So the credit cycle has to turn at some point, and I think we're really starting to see that. I think it's well documented, some of the concerns around the commercial real estate markets and post-COVID environments where less people are working, and those issues are real. So I think as we work through the next couple of quarters, there's certainly going to be an uptick on the credit side. I think relative to smaller banks, as I mentioned earlier, I think we're looking at the biggest degradation of NIMs that our industry has seen in quite some time. Time will tell as we move through the quarter, but if the incremental cost of a dollar funding is 5.50 or higher to compete with treasury bills or money market funds, and banks still have legacy assets on their books that might be yielding 2% or less, that math just doesn't, unfortunately work well. You have -3% carry on that, and that's going to hamper or dampen NIMs and earnings. So that's the theme I think we're going to see over the next couple of quarters.
I'm hopeful on the asset quality piece. Our content contributor, Joe Fennick, put an article out last week, and, underwriting is stronger than it was in 08, 09. CECL didn't even exist. It does now. So I feel, I'm hopeful that asset quality is under control. Maybe it affects the larger banks more than the community banks. Concentration risks aren't as severe with, office and commercial real estate when you move into our sector here. But so I am hopeful that that's something we don't have to deal with at a level like we did 15 or so years ago.
Yeah, I concur, Brian. I mean, I'm always the optimist. I mean, I think everything that I've said today for the listeners, it probably sounds, pretty dour, but look, I think that, one of the big themes or discussions that I'm having with folks is this just another cyclical, downturn for our industry, or are there some structural issues? The optimist in me believes it's cyclical. I think the pragmatist in me believes that there are some structural challenges that our industry faces, but I'm hopeful that the Fed can engineer a soft landing. I don't think they're done based on what they're saying, but I'm hopeful that they are going to be, conclude their rate rising campaign soon. I hope nothing breaks, but hopefully we can stabilize at current levels. That the credit picture for the industry remains pretty benign, and the advantage of time is that a lot of these lower yielding assets that are on banks' balance sheets, every day that moves forward, the duration, depending on the structure of those assets, the duration should be rolling down the yield curve, which can fix kind of the mark-to-market issues and be a catalyst to promote M&A deal math working again sooner than later.
Yeah, and I mean, all these kind of buzzwords and issues here, funding, assets, liquidity, et cetera, that you've mentioned here, that leads me to think about balance sheet management and how important that is. I mean, that's kind of in a nutshell, risk and balance sheet management kind of sunk some banks earlier this year. So I wanted to talk to you, what can banks be doing now? I think in our pre-conversation, you had actually mentioned a few examples of some specific banks who did things to weather the storm and maybe come out stronger. So I'd love to hear your take on balance sheet management for this moment.
Sure, Brian. Yeah, no, look, I think in all environments, folks should constantly be evaluating their balance sheet and whether it's positioned appropriately for different interest rate environments. I think clearly the industry was caught flat-footed given the scope of what the Fed's undertaken over the last 18 months. And this is not to defend the industry, but I'm going to do it anyway. There was a period of time prior to what the Fed was doing where we had, massive expansion of global money supply, whether it was the Federal Reserve, the Bank of China, the Bank of Japan, ECB, et cetera, like we've never seen before, concurrent with, all the QE programs and then zero interest rate policies. And there was a school of academicians within some of these governing bodies who were promoting modern monetary theory, which the theory suggests that, the amount of debt doesn't matter. Inflation's never going to be a problem. So we can have unlimited amounts of debt and keep rates at zero for so long. So, right or wrong, I think they conditioned a lot of folks, across the financial industry that rates were going to stay low forever. Obviously, the inflation genie, came out of the bottle. The Fed has been combating that along with global central banks now for the better part of the last 18 months. And that's consequently what's caused a lot of these banks, when you actually mark them to market, some has been insulated through the held to maturity designation. But when you mark the entire bank balance sheet to market, one could argue that some of these institutions are insolvent, and that's really driven by what the Fed, the environment that the Fed created. So, as we sit here today, though, the opportunity to think about restructuring the balance sheet has never been more important, and we've seen a lot of institutions do it really over the last year. The ability to look at the fixed income portfolio, If the banks have the capital to actually absorb the one-time loss, to sell lower yielding assets that might be yielding 2% or less, and to redeploy the proceeds into either higher yielding assets, they can currently get 5, 6, 7% depending on the basket of assets today, or use the proceeds to pay off overnight expensive funding. The reality is that that's going to benefit on a go-forward basis their net interest margin and thus their earning. Again, they need the capital to be able to absorb those losses, but we've seen quite a few institutions look at doing that, and I think we'll continue to see more. And I think the investment community, where you can get the earn back math as short as possible, makes a tremendous amount of sense. I think you've seen some other situations where banks are looking to sell some of their non-core businesses, and they have a lever to utilize the, in some cases, a gain on sale of those assets to then restructure and take a loss in the portfolio. There's a bank, Northwest Bank Shares, out of Western Pennsylvania. Actually, their headquarters is now Columbus, Ohio. Know them well, think very highly of them, and actually worked with them on this strategy a number of months ago. They had a mortgage servicing right portfolio that had a significant gain on it. And so they sold that MSR portfolio, recognized the gain, and then they sold quite a few fixed income investments that were low yielding at a comparable loss. So the gain on sale of the MSR offset the loss on the fixed income securities. And then they used the collective proceeds to immediately pay down some overnight funding that was expensive. And then over time, it will certainly fund their loan growth to put higher yielding assets on the books. But the investment community really loved that story when they announced that in their second quarter earnings. And strategies like that, I think, make a tremendous amount of sense. The final thing that I think folks are looking at that I think makes sense is looking at some balance sheet hedges today. Now, I think a lot of folks wish they were hedged, prior to the rates moving higher, but the ability to put a fixed, pay fixed, receive float swap on the balance sheet for a pool of assets makes sense. You're hedging against a continuous rise in rates that will cause the pool of those assets to lose market value. So you're locking that in, because on the hedge, you'll then have a gain to offset the loss. Now that works both ways, Brian. So if rates go lower, now you'll see an increase in the price or value of those pool of assets. And then you'll have a loss on the hedge, but you're essentially, that's why it's called a hedge, you're hedging yourself. But the way that the curve's priced today, the inversion of the curve, there's typically expenses associated with a hedge, but in the current environment, because again of the inversion of the yield curve and the way that the pricing works, you can actually be paid and improve your net income in the current environment. Now, what I tell folks for years, and what I would continue to tell them, is you just have to fully understand the risks associated with each of these strategies, what the upside is, what the future ramifications are, and make prudent risk management decisions. But I think in the environment that we're in, it's probably the most significant things that I think bank management teams need to look at. They've got to move the pieces of the chessboard around to improve earnings, and I think outside of the box relative to some things that they can do within the balance sheet.
Yeah, and as you're saying that, I'm thinking to myself, some of the smaller players that have less experienced executive teams, or maybe don't have the best advisory, whatever it might be, it all kind of comes down to the talent at the bank to have the wherewithal and understanding of what to do strategically. Balance sheet management filters right into that. So talent, it's the Travillian playground. Basically, what does the bank executive of the future look like? We've done quite a few CFO searches here where we've inserted people in that are quite different than their last CFO. A little bit more of a risk background, a little bit more of a capital markets, corp dev background. We've actually surprised a lot of boards and clients with backgrounds that they maybe didn't think about previous to our search. They were thinking more stereotypically about that role. So what do you think about the executive of the future? Where do they come from?
Yeah, Brian, great point. And it's you and your colleagues' job to find that talent for these institutions. Look, I think that, given the consolidation of our industry, we're creating fewer banks that are becoming larger and larger and larger. I think over time that trend will continue, and we're going to be left with a true barbell where, in 5 to 7 years, we still may have 2,000 charters, but you're going to have 100 very large banks, and then 1,900 small banks. But as those entities become larger and larger, the talent that is required across the management suite is exceptionally important. So that's beefing up, the capabilities, to support the CEO and the CFO. The larger the bank is, they typically have a head of corporate development that's a right-hand individual for the CFO for strategy and capital. Beefing up treasury teams for modeling capabilities, asset liability management, strategic thinking, I think is exceptionally important. There's a lot of talent out there. I think that there are some really good examples in our industry as well that you've seen folks in my profession on the investment banking side who've successfully transitioned from investment banker to a really strong, bank executives. A couple of examples: Luis Massiani, who I respect and I consider a close friend and colleague. Had an investment banking background, and he's helped to navigate and become the number 2 at Webster Financial. Helped them to pull off a number of strategic MOEs to create the size and scale that's necessary for them to be successful. And he's just a different thinker in a good way. I think of Dimitar Karavanov, who is at CBU, again, investment banking background, but he's now the heir apparent, which is public information for Mark Triniski's, well-deserved, transition to retirement. But Dimitar brings a different perspective, and I think that's going to serve CBU shareholders and stakeholders exceptionally well moving forward. So I'm not suggesting that that's a blueprint and that banks should be hiring folks from my industry. But I think the reality is there is a lot of talent out there, and I think folks need to think differently around how they're going to round out the executive suite from a strategy perspective, a risk management perspective, a financial perspective, et cetera, et cetera.
Yeah, totally agree. And I do think that even as one of my competitors put an article or a podcast out saying, where are all the CEO candidates? And if you are only hiring CEOs that have a CEO designation previously, you're going to miss out on a lot of emerging, exciting talent that can bring new dimensions to your business. So I'm definitely excited to help bankers, continue their quest in their careers, as well as my clients achieve their successes as well. I think that's all the time we have, Matt. I just wanted to thank you once again for being here and giving us your thoughts about M&A and balance sheet management, earnings, and of course, talent. So thanks so much.
Yeah, Brian, if I could make one final comment, because for your listeners, it sounded pretty negative on our industry, but something that I've conveyed and said forever is that there's winners and losers in every environment. And so it's the folks that kind of have their head down, they're playing the long game, they're focusing on opportunities. If despite the challenges and the lack of fun that's current in our space, keep your eye on the prize. The sun will rise tomorrow, and if you've got a good strategy and a plan, you're going to come out stronger on the other side of this cycle.
Love the optimism, Matt. Thank you so much, and appreciate your time.
Thank you, Brian. Appreciate it.